Well, that's India, it's China, and it is, the technological revolution. Plus, I think it's, let's say, maybe sovereign wealth funds, maybe it's deep pockets that understand the silver market that I think are taking silver for various reasons. And the thing that's very interesting about the silver market is physical silver is needed in the London market to clear the market. How much? It's been reported or purportedly 150 million ounces, which last time I checked, the COMEX only had about 170 million in the registered category, which is readily available to ship to London or wherever. I personally not sure it's going to take that much, but it'll take some physical to clear the market. But the ace in the hole, the outlier, David. Well, you outlined it very well, David. I mean, currently we were overbought in both gold and silver for a long time. The guys that look at technical work, the RSI, relative strength indicator, a lot of things are showing us that we were due for a correction, a pullback, profit taking, however you want to frame it. And that's taken place. And when these things happen, it's very normal that the down push is greater than the upward push, meaning markets fall faster than they go up. So we saw, like a 5%, 6%, move down in the silver market. Gold got hammered fairly well also. But these are actually healthy for the market. And the reason is you don't want a market to go straight up, because if that happens, there isn't really any support on the way up. So what you really want to see is a stair step. So silver goes from 35 to 37, 38, trades in that range, 37 to 38 for 3 weeks. Then it moves up to 40. It bounces around 40 to 42 for a month. Then it bounces up to 45 and goes down to test the 38, level, whatever. So what you want to see is support. You want to see a lot of buying in ranges as it works its way up, as I said, as a stair step. If it goes up, 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 there's no support. And it's like throwing a tennis ball in the air, David, where, you throw a tennis ball as hard as you can and it just keeps going up until it reaches that point of zero momentum and it actually stops midair for, 2 milliseconds, and then gravity takes over and starts coming down. And that's a good metaphor for a parabolic move. And I don't care if it's soybean oil, silver, or IBM shares. If you get that kind of a pattern, that kind of a hockey stick, you really have to be smart to sell in the strength, because it will come down usually very rapidly. On the other hand,
yes,
if we do what we're doing, then we are assured pretty much that we're continuing to be in a bull market that's strong. And so what happens in a bull market, I've said it too often, but it bears repeating, David, and that is the bull's function is to shake off as many longs as it possibly can. I mean, the idea of a bull rider, if you've ever been to a rodeo or watched it on TV, those guys get a big round of applause if they hang on for 8 seconds. That's a very good metaphor for how strong, especially the silver market, can be. So people that were long and bought the breakout, maybe they used my rule. Oh my goodness, David's right, it's been 3 days, I'm going long, and it was, 52 at the time, in that range. And they leveraged up and went up for a few more days after that. They better have a tight stop, because as you just said, it could pop down. So what's happened is what we call the weak hands get shaken out. People that are over leveraged get shaken out. People that have thin margins get shaken out. But I have to add one more thing, and I'll give it back to you, David, and that is, if you look at the structure of the market, it actually, in silver, has not come down to the level where a lot of these shorts have been able to cover their positions, because the open interest has stayed about the same. And that's key to note, because what that means is the guys that are on what I would say the wrong side of this market, that expect the price to keep coming down, may not get their wish and are not able to exit their shorts and are stuck, especially if the market continues higher from here. Not saying it will, but if it does, then they got to suck. So do I take a paper loss or don't I? Or can I force the market down? So we are in a really strong bull bear scenario where I would say the shorts that have always anticipated their ability to move this market around are having a heck of a lot more difficulty doing so. And that same statement applies to gold.
Corrections in a bull market serve a purpose. They eliminate weak hands. Traders who chase momentum with leverage are often shaken out first when volatility strikes. This creates short-term fear, but long-term resilience. Seasoned analysts compare silver's behavior to a bull rider challenge. Only those who hold on through the violent swings remain to benefit from the final outcome. Meanwhile, short sellers who have been waiting for prices to collapse haven't yet been able to escape their positions. Open interest remains high, suggesting those betting against silver may become trapped if upward pressure resumes and price forces them into costly losses.
Depends who you talk to. I actually called the floor of the exchange, and I have brokers on the board of trade that I know personally, and I got, I would say, inside information. But according to what they gave me for information, the $50 level was hit, what's called intraday. So there were trades made at 50 or higher, but it didn't close at 50 on that exchange. On the other exchange, I think they closed it at 52 or something. But the 50 level from the actual trading floor that day was, according to them, a matter of minutes. And according to some of the old heads that are as old as I am, they said it was maybe an hour or so. So the point being well taken is this. It did not stay at 50 for very long. Now, did it hit 50? Yes. And going to what you said and just reframing it, David, and you're spot on, that is a psychological level that really holds merit. And I think it still does, because we have seen it go past 50 and stayed there for a few days. We got prints. It closed, traded all day above 50, traded another all day above 50, traded another all day above 50. But it hasn't been a month. It's been days. And now we're below 50. So I really think it's a battle line for, let's say, the commercial interests, the bullion banks, to kind of persuade the psychology, as you said, that word, and it's a good word. Hey, 50's it for silver. It can't do more than that. See, you're not doing the right thing buying silver over $50 an ounce. Now, I don't believe that, but I do believe the psychology is to continue to beat that arena, that area of trading, to psychologically take the juice out of the bulls. In other words, to discourage them from going into the silver market at this level.
The price of silver crossing the $50 mark has become a psychological battlefield. While the level has been touched or briefly exceeded, the market hasn't yet sustained a full month above it. This allows major commercial traders, often bullion banks, to defend that ceiling and influence sentiment by convincing the public that silver cannot rise further. History shows how powerful this psychological line can be. The failed attempts in 1980 and 2011 were driven mostly by retail speculation. Today, the dynamic is changing. Long-term institutional buyers are increasing exposure, making it harder for large players to suppress upward momentum.
If you look at what happened in 1980, you can go back to the Hunt brothers, and there's a book called Silver Bulls by Paul Sarnoff. It explains almost every day leading up to the peak. It's a great read if you're a silver fanatic. In 2011, that was basically based upon, it's always paper trading. The silver market is a derivatives market, but the backup on it is 1,000-ounce commercial bars. It was very extended. I called that top, by the way. And that was mostly retail. Of course, institutions are always on the other side. But this time it is different because it's the silver market hard asset, physical commercial bars, 1,000-ounce bars, that are difficult to get in the quantity required to clear the market, which means the refiners basically are not taking any junk silver, sterling silver, silver jewelry to smelt down into 999 fine, because it takes too much time and energy, whereas they will take a 100-ounce 999 fine bar or a kilo bar that's 999.5, because all I have to do is throw that in a pot, melt it down, and pour it into a 1,000-ounce bar. So these refiners are backed up with metal that they need to refine, and they're pouring it out into 1,000-ounce bars basically as quickly as possible. There's not really that much refining capacity that takes place in the United States anymore, but there's some. most of the refining takes place in China, and China imports, the lion's share of the silver, and they export back out after being refined to the people that, moved it in, like a mining company. But most people don't know that smelters get paid in metal most of the time. So if I ship in 10 million ounces of metal and my contract is, 10% goes to them, or unless there's what's called nasties in it, the refining process is more difficult, they might get a higher amount back to them. So China is really the most, I think, swing factor in the silver market right now, and India, both, for physical 1,000-ounce bars. And recently, the Chinese have come into the market on the retail side, which really hasn't been the case for quite some time. It's been gold, and even India has kind of switched to gold as they become more prosperous. But now India is doing a lot more solar, and they have silver ETFs, which demand physical silver to back up the ETFs, and they're kind of waiting for that silver to come in to India so they can increase the share quantity, the amount of shares that they can issue, because they have the silver to back it up. So this is something that I would say I've always more or less thought or predicted that there would be a day, someday, that the commercial bar market, the physical, what's really the silver market, the derivative market that's based on commercial bars, is what takes hold, and that's happening. The other times we've had those runs, it's been more or less retail buying, retail products, 100-ounce bars, bagged silver, silver rounds, government-issued coins, and that's part of the equation. But the real silver market's determined around commercial bars, and that's where we have a problem right now. We have different prices in India than we have in China, different prices in China than we have at the LBMA, different prices at the LBMA that we have on the COMEX. So now, who's who in the zoo? If you don't know what the real price is, you can't really even hedge. And if you can't hedge, you're going to put up a sign on your website saying, we're out of silver, we're closed for business. They're probably not out of silver, closed for business. But if you can't hedge, you have got a problem if you are a big coin dealer, if you're a manufacturer of silver shot or silver wire or silver fluids or silver mesh or whatever. So it's kind of messed up the market in a way, because if you don't know what the real price is, in the future, can't hedge what you have, you're taking a big chance. So if you don't know what to do, you basically kind of quiet down and do the bare minimum that you can.
Silver's underlying supply chain is facing growing pressure. Refiners are prioritizing large commercial bars due to faster processing times, while retail products take longer and draw higher premiums. At the same time, the majority of refining capacity exists outside the United States, primarily in China, which now demands more silver internally. India is also rapidly increasing its solar production and issuing physical-backed silver ETFs, tightening supplies further. Disconnected prices across major global markets reveal growing stress, leaving refiners, industrial users, and bullion dealers unsure how to hedge inventory. When price discovery breaks down, scarcity becomes undeniable.
The bigger story is that gold is absolutely a monetary metal, and that's really what it is, period. So silver is both an industrial and a monetary metal. And so it's got a correlation with gold. I haven't checked it recently. Going back about 5 years, it was proven to be about 85% correlated, which is a very high correlation. But it also has at times when it acts more as an industrial metal like copper. So silver is sort of a dual personality, you might say. Some of the time it tracks gold stronger because its monetary demand is higher over, let's say, industrial, or at least at the margin, it's monetary demand. And at other times, the monetary demand is not very strong, like it has been not very strong in the last couple of years up until recently. I'm not talking the last couple of months, but the last few years, it's been more of an industrial story than a monetary story. Copper is a pure industrial story. So silver kind of oscillates between I'm an industrial metal or needed industrially, or I'm needed monetarily. So that's actually why you get that tracking that looks the way it looks. And copper, they call Dr. Copper. I look at it as being a very good indicator as far as what the actual need is for growth or industrialization or technology improvement on a world basis. It's pretty good at that. But actually, I've kind of changed my opinion, David, that I think oil is actually a better indicator. And oil is really not doing that well right now, but that doesn't mean it might not pick up in the future. So hopefully that was a pretty good explanation, because that's the facts.
Silver is unique in the commodity world, both a monetary alternative like gold and an industrial necessity like copper. Historically, it has tracked gold closely, especially when nations seek protection against inflation and weakening currencies. However, silver's industrial role is even more crucial today as the world transitions to electrification. Solar panels, EVs, robotics, and advanced electronics require silver at scale. When economic growth drives industrial demand at the same time, investors seek crisis protection. The result can be explosive. Analysts warn that this convergence may already be underway, creating the strongest silver bull cycle in decades.
Well, that's India, it's China, and it is, the technological revolution. Plus, I think it's, let's say, maybe sovereign wealth funds, maybe it's deep pockets that understand the silver market that I think are taking silver for various reasons. And the thing that's very interesting about the silver market is physical silver is needed in the London market to clear the market. How much? It's been reported or purportedly 150 million ounces, which last time I checked, the COMEX only had about 170 million in the registered category, which is readily available to ship to London or wherever. I personally not sure it's going to take that much, but it'll take some physical to clear the market. But the ace in the hole, the outlier, David, is this section or Article 232, which puts silver in the critical metal category. Now, it's been put on the list to be determined to be a critical mineral, but that vote has not taken place yet, and it's probably going to be delayed because of the quote-unquote close down of the government. The government comes back and says silver is a critical mineral. Then I would submit that there's a highly strong probability that the need for silver will go to the government as a strategic or critical mineral, and they would have to buy it in the open market. And the strategic stockpile in 1985 was 140 million ounces, round number. So if they all of a sudden decide this government said we need it as a critical mineral, let's stockpile it. And they said, how much do we need? We need 100 million ounces. At this point in time, that would put further stress on the market. And you also have the Saudis that bought about 1 million shares of the SLV race recently, which just puts them in the position of an authorized participant, which means they can actually use the SLV as a source to get physical metal, because if you meet the threshold, you can change that paper shares into physical metal. So that's putting further stress. And as I said earlier, India has a ETF that's backed by physical, and they're waiting to get more so they can issue more shares. There's stress in the commercial side of the market that I've never seen before, David. And that is the real silver market. Not that retail isn't important, but it's sort of it's the tail of the dog, basically. The dog is the real physical silver market backed up or played around by derivatives.
So the narrative that silver usually only runs up parabolically when there's a huge investment demand, that's not true in this case?
It's demand, and silver doesn't say, are you investing for monetary purposes? Or are you investing for industrial purposes? It really doesn't care. But we have an industrial demand that's insatiable, followed by monetary demand at a much higher level. It's institutional demand or very big, wealthy, funds or whatever that are piling on top of an industrial demand that isn't being met. So if you have an industrial demand that cannot be met by the physical supply, coupled with an investment demand, then you have what we've got. And I've said this for years, there could be or would be a day where you have both sides fighting for the same quantity, going back to your copper, gold, silver chart. What if the industrial demand is stronger than ever and the investment demand is stronger than ever at the same time? Well, that's where we're at right now.
Global reserves of physical silver available for delivery are thinning. Industrial users require guaranteed supply and cannot wait for financial markets to settle disputes. Meanwhile, large funds and even government agencies are positioning for physical procurement. The United States is considering classifying silver as a strategic asset, a move that would trigger federal stockpiling. Major sovereign wealth funds are accumulating shares in ETFs that can be redeemed for bullion, giving them direct access to physical metal. For the first time, industrial necessity and investment urgency are colliding. If both worlds compete for the same limited supply, prices could accelerate beyond anything seen in modern financial history.